Hey traders, welcome to Charts and Coffee. Great to see everyone. Happy Wednesday, everyone. All right, so what do we have on tap today? We have a lot of, we have a lot of data, and I think everyone knows when we are Wednesday, we are just in a countdown to non-farm payroll. We get the first I don't think this is as important. Really, I don't think it's important at all, other than the psychology of the event. And that is the 8/15 ADP non-farm employment change. Now, ADP does not have the same sort of um, consensus moving effect that, say, the API, the American Petroleum Institute number on a Tuesday afternoon would have in terms of the impact of the Wednesday EIA crude oil inventory. So it doesn't have that kind of synergistic feel or frankly effectiveness. However, this does put us in that mode of, okay, jobs numbers are coming, and what does this ADP number look like? It's slightly better than expected. Please know that ADP usually does not necessarily in any way reflect what we're going to see on Friday, but it's a countdown of sorts. I am far more interested in the ISM number coming out at 10. Now, this is the services PMI, not usually as much of a mover as the manufacturing purchasing manager index is. However, if you recall on Monday, we could say 10 a.m. Monday really was sort of the instigator for the strength that we saw Monday and Tuesday, and then the jolt helped on Tuesday as well with that slight miss in the job opening. So really a lot of data sprinkled with a lot of FOMC speak. All right, so then next up, scroll on down, looking into tomorrow, Natty Gas, lots of FOMC speakers, but no one is named Powell there. So not the concern about, all right, what are we going to be dealing with tomorrow? Not as big a concern there at all. And then, of course, Friday's non-farm. So lots coming up this week. All right, gang. But as always, this show is about your questions. So let's take a look at what we have lined up. And let's see here. Let's head on over to the charts. I'm using the Trading View charts here, and stoked about that. Love these charts. If you're wondering, okay, Rag, I don't use, say, Thinkorswim. I'm not on Thinkorswim. I'm on another platform, but I want to use the tools you have, whether that be Grab, Wave, or even some of the premium stuff like a V-Score or an hourly price movement range, the HPMR. Those are available on TradingView. And TradingView is a broker agnostic platform, which is great because regardless of who you trade through, you can pull this up on an iPad, on your phone. I've got TradingView running on this thing. I love that. And of course, on your desktop. So big fan of these folks. Don't know them. I'm not plugging anything I don't use. I've been using TradingView for a lot of years now. So big fan of the platform. That is what we're looking at today. And first question, editor asked, can we take a look at the SPX? Sure. Actually, it might be worth it for me to pull up. I don't have it running right now, but it might be worth it for me to go ahead and get Thinkorswim running here. And you know what? Let's do that. We'll take a look at Thinkorswim as we're speaking, because I can show you the hourly price movement ranges on the SPX, which if I'm correct, and the bot will tell me if I'm not, the next update of the HPMRs, which I believe will be released the latter part of this week, will be including the SPX. It's a request that a lot of you had for the HPMRs. Overall, I will say this, HPMR or no HPMR, editor, SPX is going to move generally same way that the S&P futures are moving. The structure is a downtrend, and it has been since, you can see right here, September 26th. We also have, and here's my Thinkorswim waking up. So let's do this. All right. SPX is in it, and they are scheduled for this next release of the updated hourly price movement ranges. Those of you that have the premium subscription, SPX is now included. Yay, bot. All right, so let's take a look. I believe this is the one that has, this should have it on there. All right, so if I'm looking at the SPX and I'm looking at the structure, remember, we're going to have a little bit more of a stock ETF type behavior from SPX, right? As opposed to pulling up the S&P futures, which, by the way, if you want to trade SPX, you can look at S&P futures. There's just no harm in that. But in the bigger picture, editor, this is a downtrend. S&P is a downtrend. It's a double red downtrend. We actually got to, I don't believe we touched the 21 propulsion. Remember, whatever we're seeing technically, I think the bigger picture, editor, is this. Whatever's going to happen this week to the averages, not just the S&P, but the NASDAQ and the Dow as well, is going to be hinging on, I would say today, the services PMI, and on Friday, everything is going to be, do we or do we not get a jobs number that disappoints? Equity markets go higher. We have one in line. Equity markets might chop around, or do we have a very strong jobs picture? Equities will likely resume the downtrend here. Technicals and trend analysis and our indicators and volume, all super important. But come Friday, it's about volume, and it's about what does that hot zone tell us about the jobs picture. That's it. So it's really difficult to sit around here and say, well, we're going to resume the downtrend. That non-farm is going to have a lot to do with it. And remember, every disappointing release, every growth picture that's weaker, every jobs picture, jolts, initial claims, non-farm that's weaker, inches us closer to the coveted Fed pivot. This is the way monetary policy shifts. Just like the data got us to where we are now, the hot inflation got us to this tightening cycle, the disappointing data on the jobs and growth front will eventually get us out of this tightening cycle. And that's just the way that it works. So data dependent is not, they say that a lot, don't they? The FOMC members. Data dependent is to a certain degree true. So just keep that in mind. One of the things I was thinking about this morning, and I tweeted it because that's where I like to put these things out there, is, when you think about what's happening in the marketplace right now, in terms of a lot of the pessimism, funny little observation I've noticed watching television and whatnot. There are two types of sort of doomsday bears, and this is going to ruffle some feathers, but that's okay. Think about why it might bother. But there's two types of doomsday bears in this market, gang. Inexperienced traders who are going to continually harken back to other 2001, 2008, 2020, and people who are trying to get on TV. I don't know of successful traders that are not optimistic about opportunity. That's not to say they're bullish, gang. And I'm telling you things that I wish someone would have told me 20 years ago. It sounds really good to be a pessimist. It kind of sounds really good to talk about how far lower a market might go, or frankly, how much higher, but how far lower, because it kind of feels experienced, and it kind of feels, well, frankly, holier than thou, right? Be careful. Be very careful. I've probably upset more people by saying things like that, but I'm telling you right now, gang, when you look over across decades of your trading experience, you're going to be far better off always being opportunistic, which is very different than always being bullish, but you're going to be far better off by being opportunistic. Opportunistic here would be, this is a downtrend, it's corrected, and there might be a short sell here. Not, we're going to 2021 lows. Not that this market's going to crash, right? So I hope that makes sense. I'm sharing this with you, gang, because over 3 decades, I wish I knew this. I wish somebody told me, Rog, quit sounding jaded and like a pessimist. Don't be a bear. Look for opportunity. And that's fine. Trade what we see. So I see that on the S&P, editor. There's opportunity on the weekly. There's opportunity on the daily. One is a buy on the weekly, and some are shorts on the daily. And if you don't want to be caught up in any of this mess of what are they going to do, when's the Fed pivot, are we going to crash, day trade. Day trade. The blissful apathy of trading, say, the first hour or two a day after the bell and just getting flat or trailing a stop. A lot of the traders in the Sector Secrets Mastery, because we day trade in there 5 days a week, are thinking to themselves, wow, this is great. Let's just put in a couple trades, control our risk. And then if we're up tomorrow, if we're down tomorrow, doesn't matter. So that's the way I'm looking at it. And I appreciate the question. Hey there, Mike. Good morning. Do we need a minor high to short LIN on the daily? Oh, gosh. I don't know what happened with Lindy. This is an XLB name, other than XLB was up. I guess the question here would be, I mean, yes is the simple answer, Mike, but what I would probably ask is when you crack open the sector that LIN exists in, are there any stocks that are in downtrends like LIN, but are holding the resistance of the wave? So I like this as a short. I'm with you. It's just really much more volatile than I would like. It's landed in a very nice volume ledge. It's piercing the point of control. Yeah, for this year, lots of volume at this level. So if we can get a minor high in this volume zone, that would be a really good setup for this trade. Looks like pre-market, we're at the lower end of the range right now. Do we need it? An inside candle would be fine. If I can't get a minor high here, Mike, an inside candle today would be fine. Or if you're willing to put on an aggro, smaller budget entry, long puts, take advantage of that. Just a smaller entry in that volume zone that you can see here. And then the point of control, which is sitting at about 285.5. All right. So cool question, Mike. Good eye. Do we just want a short strength? No, but if we have strength within the context of a downtrend, now we have structure. Now we have a strategy. Good stuff. Hey there, Raghee. Good morning. Thank you for your relentless and consistent dedication to giving us your bet. Raghee, I'll tell you what, I have made over 33 years now, tons of mistakes, incorrect mindset. I was just addressing one of them earlier. Pessimism is not going to get anyone anywhere. Doomsday calling is not going to get anyone anywhere. I'm just sharing things that I wish I would have done throughout my career rather than saying the latter half of it. So my pleasure. And thank you all for tuning in. You kidding me? Lots of places, lots of things you could be doing. Instead, you're here with the group, caffeinating and dominating. Believe me, it does not go unappreciated. I noticed the market rallied, but FedWatch tool has not changed too much. Any significance? There's always significance. I'm with you. So if we take a look at the FedWatch tool, and I was just talking about this yesterday with the futures folks and with the Sector Secrets Mastery folks. It's like, look, the real conversation is December. Where are we? 4.25% to 4.5%. If that edges to the right, if we edge towards 4.5% to 4.75%, equities will not like that. February and March, we start to see more expectation for one more quarter point hike. If we edge towards 4.75% to 5%, which is this sort of vacant area here on the graph, equities will not like that. Anything that keeps us at 4.25% to 4.5% for December and 4.5% to 4.75% for the peak target rate probability, or any of the columns to the left on this graph, equities will be fine, as long as this doesn't get any worse. And for those of you that are wondering, Rog, how has this responded to the weakness in the market, this chop that we're in? How is this responding so far? As we've moved lower, gang, many of you will notice we are a full 100 basis points or 1 full percentage point higher in terms of Fed target rate probability than we were, in August. So in that very small period of time, say mid-August to now, beginning of October, 6 weeks, 7 weeks, boom, 100 basis. Of course, equities are going to hate that because that means rates are going higher than expected. So that's what I'm looking at. As long as this doesn't get far more hawkish, then I don't expect significantly lower lows. That's been my logic the whole time, right? I don't expect a crash. I don't expect anything more than, what we've seen, which is, take a look at the chart of the S&P again. Go back to beginning part of 2022. We're testing that area of the lows of this year. And go back a little further. I think what's scary, and I get it, is two things. We're below the 200 exponential. We're below this 200 propulsion. That's that's definitely something to keep an eye on. And we haven't had much luck getting above it. And that's bearish. That's the bearish side of the equator, if you want to call the 200 what I call it, which is the equator. Bullish hemisphere, bearish hemisphere, right? And then the other thing is, if we can't hold this area, all of a sudden, 3,200 doesn't sound crazy at all. So I'm not saying there's not a path to the downside, but there's support that needs to be broken to get there. And there's probably a few other support levels that we could look at. But we are in a fairly, this is definitely, I'm not in any way denying we could head lower, right? But to say that we're going to 3,200 is not a trade. To say that there's support at this level and that we could continue to fall, that's analysis. And that's another thing that we've been talking a lot about, is the difference between analysis and a trade. Analysis is we could go to 3,200. Analysis is we could go to 3,400. You can see there's a volume ledge around 3,390. That's analysis. That's, hey, we could go there. A trade is, this is the entry, this is the stop, this is the target, right? One of those three is just an incomplete conversation. All three are, what I seek to share with members, and what I hope that when you are getting into a market, you are aware of a specific price point or zone for all three. So, Raghee, as long as that doesn't shift, we're good. We're good. Now, could other things affect market behavior? I mean, earnings, of course, etc. But as long as the target rate probability does not exceed where we are right now, there's no reason for the market indices, right? Stocks, ETFs, to be that much more bearish. Choppy, sure. Maybe revisit the lows, exceed them again a little bit, sure. But tumble, I can't see a path for that right now based on the data that we have. All right, what are my thoughts on First Solar? Heading higher? Clearly, it's surfing the wave in a big way. Last time it pulled back, it hit the 21 propulsion. That might be worth keeping an eye on. I mean, what are my thoughts on it? Rich, buy the dip, my friend. Yeah, buy the dip. It's definitely dip buyable. Yeah, that's my thought. So thank you for the question. Hey there, John. When trading futures or the underlying ETF, do I look at the current month or continuous contract? Great question. I will tell you, one of the things that I, excuse me, tend to do, where's my water? And it's not a good habit. So is I tend to pull the continuous contract up. It makes the indicators flow better. However, most of you probably know this. As we're pulling up and I'm noting the individual trades, for example, we talked about crude oil yesterday. It's the November contract of crude. It's the X contract that I'm actually going to enter based upon. But yes, I will oftentimes pull up on TradingView and toss the continuous contract. But at some point, I do need to say, all right, here's the continuous crude. And then here's CLX. And, I need to do both. And absolutely. So I tend to look at the continuous contract. And it's not a matter of preference. It's a little bit a matter of ease. But when we are putting our order in on our platform, we need to be keenly aware of what contract it is. And near first notice date and the roll from the current front month to the next, a lot of times our platforms will not automatically roll to the front month contract that we are focused on entering. So we have to be aware of what the biggest challenge is this, John. What month is this continuous contract currently reflecting? So if we're trading at 87.06 on the November contract and I go to the continuous contract, I've got to be at that level, right? I've got to be looking at, so if I'm on CL1, right, which contract is it reflecting, right? And that's what you always have to be aware of. Now, one of the things that I've mentioned specific to crude, since I'm on the topic, is trading the USO. Now, if you're talking about S&P, here's your S&P right there. So we're sitting at 3760, right? And here is ES December. ES said 22. There we go. And 3760, right? So as long as they're corresponding, you want to know what current front month is being reflected in price on the continuous. So that's the easy way to do it. That's the easy way to do it. Really, really, really easy. And if you're not sure, a lot of folks, they say, Rog, what's the front month? It's the one that most of the open interest, different than volume, gang, it's where most of the open interest is right now. All right, gang. And just like that, holy cow, how does 20 minutes fly by like that? Thank you, as always, for being a part of our Charts and Coffee. Thank you for caffeinating and dominating each and every morning. Gang, this month, October marks 2 years of Charts and Coffee. Thank you so much. I think we've only missed maybe 1 or 2 shows, holidays, everything. So thank you so much. 2 years of Charts and Coffee. Unbelievable. Thank you for being willing to caffeinate and dominate every morning at 9 a.m. Futures folks, Sector Secrets Mastery. We're going to go ahead and day trade the first hour. I'll see you in the room in just a moment. Everyone else, come on over at some point. Come join us at Simpler Futures and see what we're doing, or my Sector Secrets Mastery. See what we're doing. We'd love to see you there. When you show up, let me know that you're in Charts and Coffee. Give me a shout out. All right, gang. I will talk with you soon. Be good to each other.